getting my kids some lunch. Departments and key people within an insurance company. Departments within an insurance company. Throughout this course, you will see references to different departments within an insurance company. The marketing or sales divisions are responsible for increasing the number of prospective applicants, thereby increasing the number of insureds through various advertising mediums. That's actually what my background is in marketing. The sales department is typically the department completing the application and one-on-one appointments with prospective buyers. The underwriting department is responsible for applications, conducting investigations to gain additional information about applicants, assigning risk classifications, and approving or declining an application. The claims department is responsible for processing, investigating, and paying claims for losses incurred by insureds. And the actuarial department calculates policy rates, reserves, and dividends, and makes other applicable statistical studies and reports focusing on morbidity and mortality tables. Cool. Key people within an insurance company. Producers. Producers refer to the full range of individuals who solicit insurance products to the public. The various types of producers include agents, that's what I am, who represent the insurer, which sponsors them. 2, brokers, who represent themselves and the insured, client or customer, which I would assume the agent is also a broker in terms of who signed applicants. Once they start signing applicants up. Sorry, there we go. Solicitors, who represent and solicit insurance on behalf of an agent. And service representatives, who are employees of an insurer. A little dry. Service representatives who do not engage in sales activities that pay commissions need not be licensed. If commissions are paid, the recipient must possess an insurance license. Any person who solicits and countersigns policies or collects premiums from policy owners must be licensed in most locales. Licensed producers are obligated to act in a fiduciary capacity on behalf of the insurers with which they place insurance business and the clients they represent in insurance transactions. Producers are typically considered to be part of the sales department. Underwriter refers to the person who identifies, assesses, examines, and classifies the amount of risk represented by an applicant, the proposed insured, to determine if coverage should be provided and if so, at what cost, which is the premium. An underwriter approves or declines insurance applications and determines the cost to provide insurance. An actuary refers to the person who calculates policy rates, reserves, and dividends and makes other applicable statistical studies and reports. The actuary is concerned about the cost of insurance as a whole or for a specific class of risk. An insurance adjuster is a person who engages in investigative work to obtain information for adjusting, settling, or denying insurance claims. An insurance adjuster will primarily use claim forms, but depending on the claim, may also be involved with investigations on the insured's conduct or identity, habits, conduct, business, occupation, honesty, integrity, or credibility, etc. A public adjuster refers to a person who, for compensation, acts on behalf or aids an insured with settling an insurance claim. So that would apply to both sides. How insurance is sold. Most consumers purchase insurance through licensed producers who present insurers' products and services to the public via active sales and marketing methods. Insurance producers may be agents who represent a particular company, or brokers who are not tied to any particular company and can represent many insurers' products. In most states, brokers and agents must be contracted and appointed with an insurer prior to taking in an application for the insurer. As an agent's contract, as a broker's contract, so these are two different things. This contract and appointment with the insurance company are what grant the agent or broker authority to bind an insurer to an insurance contract. In a sales transaction, agents represent the insurer and brokers represent the buyer. In any dispute, the insured or beneficiary and the insurer, the agent who solicits an insurance application, represents the insurer and not the insured or beneficiary. Agents are also classified as captive or career agents and dependent Independent agents. A captive or career agent works for one insurance company and sells only that company's insurance policies. An independent agent works for himself and sells the insurance products of many companies. In most states, the agent may represent as many insurance as will appoint him. There are three systems that support the sale of insurance through agents and brokers. These are the career agency system, personal producing general agency system, and independent agency system. Career agency system. Did you flush, son? Are you on the body? Career agencies are branches of major stock and mutual insurance companies that are contracted to represent an insurer in a specific area. In career agencies, insurance agents are recruited, trained, and supervised by either a manager employee of the company or a general agent who has a vested right in any business written by the general agent, the GA's agents. GAs, general agents, may operate strictly as managers or they may devote a portion of their time to sales. The career agency system focuses on building sales staff. Managerial system. With the managerial system, branch offices are established in several locations. Instead of a general agent running the agency, a salaried branch manager is employed by the insurer. The branch manager supervises agents working out of that branch office. The insurer pays the branch manager's salary and pays him a bonus based on the amount and type of insurance sold and the number of new agents hired. Personal Producing General Agency System. The Personal Producing General Agency (PPGA) system is similar to the career agency system. However, PPGAs do not recruit, train, or supervise career agents. They primarily sell insurance, although they may build a small sales force to assist them. The PPGAs are generally responsible for maintaining their own offices and administrative staff. Agents hired by a PPGA are considered employees of the PPGA, not the insurance company, and are supervised by regional directors. Excuse me, I gotta return sorry, we'll edit this out. Independent agency system. A creation of the property and casualty industry. Does not tie a sales staff or agency to any one particular insurance company. Instead, independent agents represent any number of insurance companies through contractual agreements. They are compensated on a commission or fee basis for the business they produce. This system is also known as the American Agency System. Aptly named American Agency System. While most other methods of selling insurance, while most insurance is sold through agents or brokers under the systems previously described, a large volume is also marketed through direct selling and mass marketing methods. With the direct selling method, the insurer deals directly with customers by selling its policies through vending machines, advertisements, or salaried sales representatives. No agent or broker is involved. A large volume of insurance is sold through mass marketing techniques, such as over the internet, newspaper, magazine, radio, and television ads. Mass marketing methods provide exposure to large groups of consumers, often using direct selling methods with occasional follow-up by agents. Career agencies recruit, train, and supervise agents through managers or general agents. They primarily build staff. Personal Producing General Agencies do not recruit, train, or supervise agents. They primarily sell insurance. Independent agents, the American Agency System, represent any number of insurance companies through contractual agreements. How insurance is sold. Trying to respond to my message. Evolution of industry oversight. The insurance industry is regulated by a number of authorities, including some inside the industry itself. The primary purpose of this regulation is to promote the public welfare by maintaining insurance companies' solvency. Other purposes are to provide consumer protection and ensure fair trade practices and fair contracts at fair prices. It is essential that insurance agents understand and obey the insurance laws and regulations. What's going on here? My team is sending messages. Okay, notice the calendar. May. All right. A brief overview as far as the history of insurance regulation will show a seesaw between states' authority and the federal government. Though a balance between these two bodies have been reached and maintained for many years, arguments favoring control by one governing authority over another are still being waged. All right, some facts for us. 1868, Paul versus Virginia. This case, which the U.S. Supreme Court decided, involved one state's attempt to regulate an insurance company domiciled in another state. The Supreme Court sided against the insurance company, ruling that the sale and issuance of insurance is not interstate commerce, thus upholding states' right to regulate insurance. So that must have been Virginia helping that out in 1868. 1944, United States versus the Southeastern Underwriters Association, SEUA. The decision of Paul versus Virginia was held for 75 years before the Supreme Court again addressed the issue of state versus federal regulation of the insurance industry. In the SEUA case, the Supreme Court ruled that the insurance industry is a form of interstate commerce. So, as such, the insurance industry should be regulated by the federal government and subject to a series of federal laws, many of which conflicted with existing state laws. The decision did not affect states' power to regulate insurance, but it did nullify state laws that conflicted with federal legislation. The result of the SEUA case was to shift the balance of regulatory control to the federal government. So essentially, what was needed, because just a background fact on myself, I have a degree in political science from Arizona State University. Go Devils. So, fork 'em. When it comes to the early legislation or just early of insurance, at first we were deciding after the 1868 case that states are allowed to regulate within their state the insurance that's being issued. But in 1944, there's a general baseline regulation that all states must have to adhere to, as they're still able to hold regulatory powers within their state. They all have to pretty much be upheld to federal regulatory government standards. Next year, 1945, the McCarran-Ferguson Act. The turmoil created by the SEUA case prompted Congress to enact Public Law 15, the McCarran-Ferguson Act. This law made it clear that the state's continued regulation of insurance was in the public's best interest. However, it also made possible the application of federal antitrust laws to the extent that the insurance business is not regulated by state law. This act led each state to revise its insurance laws to conform to federal laws. Today, the insurance industry is considered to be state regulated. Any person who violates the McCarran-Ferguson Act faces a fine of $10,000 or up to 1 year in jail. So, again, we have the responsibility of states to conform to federal regulations, but also laws within their state. That's politics for you. In 1958, go back to that, any person that didn't do that was held up to a year in jail and $10,000 back in 1945. That sounds like a heavy fine now. Today's money. 1958, intervention by the FTC. In the mid-1950s, the Federal Trade Commission sought to control the health insurance industry's advertising and sales literature. If anybody hasn't seen Mad Men, I would suggest seeing that to look at those ads that they were producing. In 1958, the Supreme Court held that the McCarran-Ferguson Act disallowed such supervision by the FTC, a federal agency. Additional attempts have been made by the FTC to force further federal control, but none have been successful. That's interesting. They tried it and failed. 1959, intervention by the SEC. In this instance, the issue was variable annuities. Is a variable annuity an insurance product that should be regulated by the states, or a securities product that should be regulated federally by the Securities and Exchange Commission? The Supreme Court ruled that federal securities laws apply to insurers that issued variable annuities and thus required these insurers to conform to both SEC and state regulation. The SEC also regulates variable life insurance. Well, there you have it. A very pivotal regulatory rule there. The SEC, being a federal security commission, control the stock market, obviously, or control, at least rule on it. So that are going to be producing income, assets. So as opposed to insurance, you have purely risk-based transfers. Securities will allow you to make money, a lot of money, or lose money. So essentially we have to regulate securities a little differently than insurance. And variable life insurance, IULs, those types of policies are considered securities. Interesting. Which would have to apply taxes or not. We're going to find out. 1970, the Fair Credit Reporting Act. In an attempt to protect an individual's right to privacy, the federal government passed the Fair Credit Reporting Act, which is the authority that requires fair and accurate reporting of information about consumers, including applications for insurance. Insurers must inform applicants about any investigations that are being made upon the completion of the application. If any consumer report is used to deny coverage or charge higher rates, the insurer must furnish to the applicant the name of the reporting agency conducting the investigation. Any insurance company that fails to comply with this act is held liable to the consumer for actual and punitive damages. The maximum penalty for obtaining consumer information reports under false pretenses is $5,000 and 1 year imprisonment. I would assume you need to be telling the person, if you're of course an insurer, that you are getting this report and from where, which is only fair. So, 24 more years later, United States Code, sections 1033 and 1034, according to 18 United States Code, 18 USC 1033 and 1034, it is a criminal offense for an individual who has been convicted of a felony involving dishonesty or breach of trust to willfully engage or participate in any capacity in the business of insurance without first obtaining a letter of written consent to engage in the business of insurance from the regulating insurance department of the individual state of residence. So they can't even buy insurance until a letter of consent to engage in the business of insurance. Fraud and false statements federal law makes it illegal to lie, falsify, or conceal information orally or in writing from a federal official. As it applies to insurance, any person engaged in interstate insurance business who engages in intentional, unfair, or deceptive insurance practices or overvalues an insurance product in a financial report or document presented to a regulatory official will violate federal law. Other violations include, but are not limited to, embezzling money from an insurance company, misappropriating insurance premiums, and writing threatening letters to insurance offices. The punishment for violation is a fine of up to $50,000, imprisonment up to 15 years, and license revocation. An individual convicted of a felony involving dishonesty may engage in insurance business only after receiving the written consent from the state's insurance regulatory agency and a 1033 waiver. The Karen-Ferguson Act made it clear that the state's continued regulation of insurance was in the public's best interest. The National Conference of Insurance Legislators, NCOIL, was formed to help legislators make informed decisions on insurance issues that affect their constituents and declare opposition to federal encroachment of state authority to oversee insurance business, as authorized by the McCarran-Ferguson Act of 1945. So, states' rights are very strong with this, but that entire union of states' rights is going to be regulated by the federal level. 1999, Financial Services Modernization Act, the Gramm-Leach Bliley Act, or GLBA. This act allowed commercial banks, investment banks, retail brokerages, and insurance companies to engage in each other's lines of business. The Financial Services Modernization Act repealed the Glass-Steagall Act of 1933, which barred common ownership of banks, insurance companies, and securities firms, and erected a regulatory wall between banks and non-financial companies. This act requires financial institutions, including insurance companies, to protect the privacy of their customers' personal information. The GLBA also recommends that state insurance regulators create regulations regarding the protection of consumers' personal information. The main components of the rule are that financial institutions must notify consumers about their privacy policies, provide consumers with the opportunity to prohibit the sharing of their protected financial information with non-affiliated third parties, obtain affirmative consent from consumers before sharing protected health information with any other parties, affiliates or non-affiliates, and in 2001, Uniting and Strengthening America by Providing Appropriate Tools Required to Intercept and Obstruct Terrorism Act. I think this is one of the most interestingly named acts in American history. They got real creative, but it is the Patriot Act, the USA Patriot Act, uniting and strengthening America by providing appropriate tools required to intercept and obstruct terrorism. Now, you have to be creative because it is very, very specific in terms of this act, just by knowing some political history, because I have my background in that. So I'm familiar with this first through civil studies and things like that. So let's see what applies to insurance. The Patriot Act, which amends the Bank Secrecy Act, the BSA, was adopted in response to, of course, 9/11, 2001, terrorist attacks. The Patriot Act is intended to strengthen U.S. measures to prevent, detect, and deter terrorists and their funding. The act also aims to prosecute international money laundering and the financing of terrorism. These efforts include anti-money laundering tools that impact the banking, financial, investment communities. Essentially, oversight, access to these records to verify if money laundering is taking place. That's from how I will be able to interpret that. Also, the 2003 Do Not Call Implementation Act. The Do Not Call Registry allows consumers to include their phone numbers on the list to which telemarketers cannot make solicitation calls. Calls made on behalf of charities, political organizations, and surveys are exempt. Insurance calls are not exempt from the Do Not Call registry. I always see leads in my lead pack that say do not call, and I don't call them. I mean, they should be taken out of my lead pack, but I just add them back to the list. 2003, the CAN-SPAM Act. This act creates rules for commercial emails and messages. I'm familiar with that as well from my marketing background. Specifically, the regulation outlines the right for a consumer to request a business to stop sending emails, the requirements for business to honor such requests, and the penalties incurred for those who violate the act. The act covers all electronic mail messages with the primary purpose of advertisement or promotion of a product, service, or commercial websites. The act does not apply to transactional and relationship messages. According to the Federal Trade Commission, the main requirements of the CAN-SPAM Act include: don't use false or misleading header information, don't use deceptive subject lines, identify the message as an advertisement, include the company's valid physical postal address every email, tell recipients to opt out of receiving future emails, and return email address or another easy internet-based way to allow people to communicate with their choice of opt-out. Honor opt-out requests promptly within 10 business days. Don't charge a fee or require the person to give personally identifiable information beyond an email address, or make overly or make process. I think that may be a typo. 2010, the Patient Protection and Affordable Care Act. We all know about that one. Often shortened to the ACA, Affordable Care Act, it represents one of the most significant regulatory overhauls of health insurance and expansions of health insurance coverage in U.S. history. That's why I love when they call it Obamacare. No matter who says what about what, who stands on what, Obama did accomplish getting more millions of Americans covered under health insurance than anybody else. That is by the numbers. And he got this act passed, and I cannot wait to be in it, but more so just see which we have been seeing over these last 10 years or 14 years. The chronology, yeah. The chronology reflects the courts and federal government's roles in regulating the insurance industry. All states are interested in protecting the interests of the buying public, and as a result, the actions of individuals soliciting insurance sales are strictly regulated. Laws regarding insurance marketing, trade practices, and regulation can vary from state to state, but overall, there are more similarities than differences. It is imperative that you examine and understand your state's specific laws, which will be thoroughly covered towards the course's end. Let us take a look at how individual states regulate this and how the industry practices self-regulation. Once again, this is Georgia State that I'm going over because I work out of Georgia State, but I do plan on expanding. Laws regarding insurance marketing, trade practices, and regulation can vary from state to state, but overall, there are more similarities and differences. It is crucial that you examine and understand your state's specific laws, which will be thoroughly covered towards the end. So essentially, they want me to reiterate that. National Association of Insurance Commissioners. All state insurance commissioners or directors are members of the National Association of Insurance Commissioners, the NAIC. This organization has committees that regularly examine various aspects of the insurance industry and recommend applicable insurance laws and regulations. The NAIC has 4 broad objectives: to encourage uniformity among the state insurance laws and regulations, to assist in the administration of those laws and regulations by promoting efficiency, to protect the interests of policy owners and consumers, and to preserve state regulation of the insurance business. So, it's simple. Looking at an organization of commissioners that look to regulate and be uniform across the board in that regulation. And then those laws better, make those regulations better, more efficient, protect the policy owners. That's the main thing in my career arc. I want to obviously protect as many people as possible, but in the most fiduciary way, most educational way, as you see. Unfair Trade Act. Most jurisdictions have adopted the NAIC's Unfair Trade Practices Act. This act gives the head of each state's insurance department power to investigate insurance companies and producers, to issue cease and desist orders, and to impose penalties. The act also gives officers the authority to seek a court injunction to restrain insurers from using any methods believed to be unfair. The context of unfair trade practices is misrepresentation and false advertising, coercion or intimidation, unfair discrimination, and inequitable administration of claims settlements. Advertising code. A principal problem of states in the past was regulating misleading insurance advertising and direct mail solicitations. Many states now also subscribe to the advertising code developed by the NAIC. The code specifies certain words and phrases that are considered misleading and, as such, cannot be used in advertising of any kind. Also required under this code is the full disclosure of policy renewal, cancellation, and termination provisions. That's probably the fine print you see in all these commercials. Claim settlement practices. While specific time frames may vary from state to state, All states require prompt, fair, and equitable claim settlement practices. State guarantee associations. I think that has to be guarantee instead of guarantee because it's with a Y. State guarantee. State guarantee associations. All states have established guarantee funds or guarantee associations to support insurers and protect consumers if an insurer becomes insolvent. Should an insurer be financially unable to pay its claims, the State Guarantee Association will step in and can cover the consumer's unpaid claims up to a specific amount. Insurance companies each state association through assessments, while policy owners are offered protections under the State Guarantee Association. Producers are prohibited from using these protections in their sales presentations. So you don't need to use them, but yeah, if that was the case, you would be prohibited from doing that. State Guarantee Associations are funded by insurance companies through assessments and exist to protect consumers if an insurer becomes insolvent. Rating services. While not technically insurer oversight, rating services help publicize the financial health of insurers. The financial strength or solvency and stability of an insurance company are two vitally important factors to potential insurance buyers and insurance companies. The primary purpose of a rating service company such as AM Best or Fitch Ratings or Standard & Poor's and Moody's is to determine the rated company's, the insurer, financial strength. An insurer's financial strength can be evaluated by looking at the company's reserves and liquidity. I like that definition because with the company I'm with, they have an A+ rate with AM Best, and it's very interesting because I haven't looked at other companies' ratings, but I'm assuming that that's good. Reserves are the accounting measurement of an insurer's future obligations to its policyholders. Excuse me. Need some more coffee. Reserves are the accounting measurement of an insurer's future obligations to its policyholders. They are classified as liabilities on the insurance company's accounting statements since they must be settled at a future date. Right. The liquidity, a company's ability to make an payouts to policy owners, basically cash on hand. States require various minimum reserves and liquidity thresholds prior to issuing a certificate of authority and verify these thresholds periodically through an examination of insurer financial records. That's why it's illegal to falsify those records. The National Association of Insurance and Financial Advisors, National Association of Health Underwriters, the NAIFA, and NAHU. Members of these organizations are life and health agents dedicated to supporting the industry and advancing the quality of service provided by insurance professionals. These organizations created a code of ethics detailing the expectations of agents in their duties towards clients. So that would be the National Associations of both financial advisors and health underwriters. Agent marketing and sales practices. Marketing and selling financial products such as life insurance and annuities requires a high level of professionalism and ethics. Every state requires its licensed producers to adhere to specific standards to protect consumers and promote suitable sales and application of insurance products. Some of these standards include selling to needs. The ethical agent determines the client's needs and then determines which is best suited to address those needs. Two principles of needs-based selling include finding the facts and educating the client. That's what we do. I love doing that. Suitability of recommended products. The ethical agent assesses the correlation between a recommended product and the client's needs and capabilities by asking the following questions. What are the client's needs? What products can help meet those needs? Does the client understand the product and its provisions? Does the client have the capability financially and otherwise to manage the product? Is this product in the client's best interest? Once again, that's why I love the company I'm with, because that's all we ask. And if it's not, then we are, of course, not going to go forward with the application. Full and accurate disclosure. The ethical agent makes it a practice to inform clients and about. Ethical agent makes it a practice to inform clients about all aspects of the products recommended, including benefits and limitations. There should never be an attempt to hide or disguise a product's nature or purpose or the company being represented. Insurance products are highly effective financial planning tools. They should be presented clearly, completely, and accurately. Documentation. The ethical agent documents each client's meeting and transaction. The agent uses fact-finding forms and obtains the client's written agreement for the needs determined, the products recommended, and the decisions made. Some documentation is required by state law. Ethical agents know these laws and follow them precisely. Using law. Ethical agent knows that a sale does not mark the end of a relationship with a client, but rather the beginning. Routine follow-up calls are recommended to ensure the client's needs are always covered and the products in the imp are still suitable. When clients contact their agents for service or information, these requests are given top priority. Complaints are handled promptly and thoroughly. Producer responsibilities. The producer is the conduit between the company and the insurance buying public and must make sure that at all times their actions are compliant with all insurance regulations. Responsibilities include to help all insurance company customers with the best service possible, to solicit new business for the company they represent by assisting clients in the process of acquiring products from application to policy delivery. This responsibility includes the requirement of being extremely knowledgeable about all the company products and services, guide customers to the right products to meet their actual needs, and maintain such a relationship regularly. Build a more substantial business for the company by keeping current customers satisfied and actively seeking referrals for new business. Diligently assist in the claims process. Keep customers apprised of continuing developments with any claims, and help assure a prompt and equitable claims experience. The producer must acutely be aware of company underwriting guidelines to minimize wasting the underwriter's valuable time and skills on poorly matched products. And customers to, this is where the typos come in at. Let me read ahead right quick. It's probably, the producer must be acutely aware of company underwriting guidelines to minimize wasting the underwriter's valuable time and skills on poorly matched products and customers, and to assist the underwriter in any way to facilitate the application process. Buyer's guides and policy summaries to help ensure that prospective insurance buyers select the most appropriate plan for their needs and to improve their understanding of basic product features. Most states require agents to deliver a buyer's guide to consumers whenever they solicit insurance sales. These guides help explain various types of life insurance products, including the variable annuities, in a way that the average consumer can understand. In addition, a policy summary containing information about the specific policy being recommended must be given to a potential buyer. It identifies the agent, the insurer, the policy, and each rider. It includes information about premiums, dividends, benefit amounts, cash surrender values, policy loan interest rates, and life insurance indexes of the specific policy being considered. Most states require this to be done before the applicant's initial premium is accepted. That is the wait period. Obviously, you want to give the person the application as well as the information as they sign. The summary also contains cost indexes that help the consumer evaluate the suitability of the recommended product. The net payment cost comparison index gives the buyer an idea of the policy's cost at some future point in time compared to the death benefit. The surrender cost comparison index compares the cost of surrendering the policy and withdrawing the cash values at some future time. Of course, you can take that cash value without surrendering the policy, but it's up to you. Chapter summary. All right, we're going to go over these Keywords again, more, looks like. Key points to remember from this chapter include insurance, the transfer of risk from one party to another through a legal contract, or the transfer of risk through the pooling of funds, so the accumulation of funds. The benefit of insurance is that most contracts offered to individuals and organizations in society, including health, property, and casualty policies, are contracts of indemnity whose primary purpose is to pay off financial losses and reimburse the insured. Insurance evolved to produce a practical solution to economic uncertainties and losses. Companies that sell more than one line of insurance are multi-line insurers. Stockholders may or may not be policyholders. Life insurance creates an instant estate, regardless of when the death occurs. There are two types of insurance companies, private and government. Private versus government insurance. Companies that sell more than one line of insurance are known as multi-line insurers. That's a duplicate, I guess. I don't know why that's there twice. A stock insurance company typically issues non-participating insurance policies. Non-participating policies do not allow policyholders to participate in board elections or dividends, and instead to increase profit for the shareholders. Mutual companies are referred to as participating companies because the policy owners participate in dividends. Participating policies allow policyholders to participate in the company by electing the board of directors and receiving dividends from the divisible surplus. The divisible surplus is the amount of earnings paid to policy owners as dividends after the insurance company sets aside funds required to cover reserves, operating expenses, and general business purposes. A pure assessment mutual company operates on the basis of loss sharing by group members. A risk retention group or a risk purchasing group only has to be licensed in one state but may insure members in any state. Reciprocal insurers are organized on the basis of ownership by their policyholders. Characterized as a fraternal benefit society, the organization must be nonprofit, have a lodge system that includes ritualistic work, maintain a representative form of government with elected officers. Lloyd's of London is not an insurer, but rather a Lloyd's of London is not an insurer, but rather a syndicate of individuals and companies that individually underwrite insurance. The company transferring the risk is called the ceding company. The company assuming the risk is the reinsurer. In a reinsurance agreement, the insurance company that transfers its loss exposure to another insurer is called the primary insurer. The most common reinsurance contract between insurance companies is called treaty reinsurance, which involves an automatic sharing of risk assumed. Most common reinsurance companies get treated an insurer established and owned by a parent firm for the purpose of insuring the parent firm's losses. Loss exposure is known as a captive insurer. Surplus lines refer to the non-traditional insurance market. Industrial insurance is characterized by relatively small face amounts with premiums paid weekly. A self-insurer establishes a self-funded plan to cover potential losses. The marketing or sales divisions are responsible for increasing the number of prospective applicants. The sales department is typically the department completing the application. The underwriting department is responsible for reviewing applications, conducting investigations to get information about applicants, assigning risk classifications, and approving or declining an application. The claims department is responsible for processing, investigating, and paying claims for losses incurred by insureds. The actuarial department calculates policy rates, reserves, and dividends, and makes other applicable The actuarial department calculates policy rates, reserves, and dividends, and makes other applicable statistical studies and reports focusing on morbidity and mortality tables. In any dispute between the insured or beneficiary and the insurer, the agent who solicits an insurance application represents the insurer and not the insured or beneficiary. Agents are also classified as captive or career agents and independent agents. Career agencies are branches of major stock and mutual insurance companies that are contracted to represent an insurer in a specific area. 1968, Paul versus Virginia, the case that which the Supreme Court decided involved one state's attempt to regulate an insurance domiciled in another state. Court ruled state had regulatory powers. United States versus the SEUA. In the SEUA case, the Supreme Court ruled that the insurance industry is subject to a series of federal laws, many of which conflicted with existing state laws. As such, insurance is a form of interstate commerce to be regulated by the federal government. 1945 McCarran-Ferguson Act. This law made it clear that the state's continued regulation of insurance was in the public's best interest. However, it made possible the application of federal antitrust laws to the extent that the insurance business is not regulated by state laws. 1958, intervention by the FTC. In 1958, the Supreme Court held that the McCarran-Ferguson Act disallowed such supervision by the FTC, a federal agency, and additional attempts have been made by the FTC to force further federal control, but none have been successful. Intervention by the SEC in 59, the Supreme Court ruled that federal securities laws applied to insurers that issued variable annuities and thus required insurers to conform to both SEC and state regulation. The SEC regulates variable life insurance. 1970, the Fair Credit Reporting Act requires fair and accurate reporting of information about consumers, including applications for insurance. Insurers must inform applicants about any investigations that are being made upon completion of the application. 1994, United States Code sections 1033 and 1034. According to 18 USC 1033 and 1034, it is a criminal offense for an individual who has been convicted of a felony involving dishonesty or breach of trust to willfully engage or participate in any capacity in the business of insurance without first obtaining a letter of consent to engage in the business of insurance from the regulating agency department of the individual state of residence. 1999, Financial Services Modernization Act. In 1999, the Congress passed the Financial Services Modernization Act, repealed the Glass-Steagall Act. Under this new legislation, commercial banks, investment banks, retail brokerages, and insurance companies can now enter into each other's business. All right, the USA Patriot Act. The Patriot Act, which amends the Bank Secrecy Act, was adopted in response to the 9/11 terrorist attacks. The Patriot Act is intended to strengthen U.S. measures to prevent, detect, and deter terrorists and their funding. The Act also aims to prosecute international money laundering and the financing of terrorism. These efforts include anti-money laundering tools that impact the banking, financial, and investment communities. 2003, the Do Not Call Implementation Act. The Do Not Call registry allows consumers to include their phone numbers on the list to which telemarketers cannot make solicitation calls. 2010, Patient Protection and Affordable Care Act. Often shortened to the ACA, it represents one of the most significant regulatory overhauls and expansions of health insurance coverage in U.S. history. Sounds good again when you hear it and say it. Express authority. The authority a deliberately gives to its agent. Implied authority is the unwritten authority which is not expressly granted, but which the agent is assumed to have in order to transact the business of the principal. Apparent authority is the appearance or assumption of authority based on the principal's actions, words, or deeds. Rating service. In the insurance industry, a rating service company's primary purpose is to determine the financial strength of the industry's insurers. Reserves are the accounting reserves of an insurance obligations to its policyholders. Liquidity indicates a company's ability to make unpredictable payouts to policyholders. Liquidity indicates a company's ability to make unpredictable payouts to policyholders. All right, review notes, basic principles of insurance. Another hour. I'm a little tired. I think I'm going to have to take a break from this and get started. Well, we're going to finish this chapter up right now. Role of insurance. Insurance spreads the risk of loss from one person to a large number of persons through the pooling of premiums. Insurance is the transfer of risk from one party to another through a legal contract, or the transfer of risk through pooling of funds. The policy owner is transferring the chance of possible funds to another party, the insurer. The insurer assumes since it receives the premium. When the transfer of risk is accomplished by purchasing an insurance policy, the policy owner obtains a large quantity of coverage in return for a small fee, it's a premium. Benefits and costs of insurance to society. Most contracts of insurance are contracts of indemnity designed to pay off financial losses and reimburse the insured. The premium cost can be reduced when the insured implements loss control measures, for example, smoke alarms or a sprinkler system, to lower the chance of loss occurring in the first place. Insurers take some of their revenue and invest it back into local and national economies to benefit all societies. Private commercial insurance companies. Anything not owned by the federal or state government is typically considered a commercial or private insurance company. A company that sells only one line of insurance, for example, only health insurance, is known as a monoline insurer. Companies that sell more than one line of insurance are known as multi-line insurers. A stock company is, let's do the stock companies non-participating. A stock insurance company is a private organization organized and incorporated under state laws for the purpose of making a profit for its stockholders. It is structured the same as any corporation. Stock dividends are paid to stockholders. Directors and officers are responsible to the stockholders. A stock company is referred to as a non-participating company because policyholders do not participate in the dividends. Stock companies look to grow their earned income, earned surplus, or post-tax earnings, not paid in dividends. Earnings retained by a company are considered equity and such are owned by shareholders. It's a big page here. Mutual insurance companies participating. Mutual insurance companies are also organized and incorporated under state laws, but they have no stockholders. The owners are the policyholders. Anyone purchasing insurance from a mutual insurance is both a customer and an owner. And policy owners have the right to vote for the members of the board of directors. Mutual companies mutual companies are referred to as participating companies because the policy owners participate in dividends by issuing participating policies that may pay policy dividends. Mutual insurers allow their policy owners to share in any company earnings. The divisible surplus is the amount of earnings paid to policy owners as dividends after the insurance company set aside funds required to cover reserves, operating expenses, and general business purposes. Policy dividends represent a refund of the portion of premium remaining after the company has set aside the necessary reserves and has made deductions for claims and expenses. Again, I definitely needed to get some more of that coffee or take a run around the block. Juice is pumping. Policy dividends represent a refund of the premium remaining after the company has set aside necessary reserves and made deductions for claims and expenses. Surpluses are typically distributed to policy owners on an annual basis. A stock company may be converted into a mutual company through a process called mutualization. mutual companies can convert to stock companies through a process called demutualization. A stock insurance company issuing both participating and non-participating policies is referred to as a mixed plan. Participating policies allow policyholders to participate in the company by electing the board of members or board of directors and receiving dividends from this divisible surplus. Non-participating policies do not allow policyholders to participate in elections or dividends and instead aim to increase profit for the shareholders. Strong assessment mutual insurers assessment mutual classified by the way in which they charge premiums. A pure assessment mutual company operates on basis on loss sharing by its group members. No premium is payable in advance. Instead, each member is assessed a portion of the losses actually occur. In addition, an advance premium assessment mutual charges a premium at the beginning of the policy period. If the original premiums exceed operating losses, the surplus is returned to the policyholders as dividends. If total premiums are not enough to meet losses, then additional assessments are levied against the members. Wow, interesting there.